welcome to BizTech's Inside Trading Show. This show is all about trading. Now, every week we will discuss what trading is all about and what are the required habits of a successful trader. We also share trading ideas and themes to help you make money. Now, with me today is my regular co-host, Phan Vee Leung. He's the founder and CIO of Track Record Asia. He's coming out of Singapore. And we have James Whelan, Managing Director of AMFEX, which is the Australian Mutual Funds Exchange. And he's coming in out of Australia. Gentlemen, welcome to the show.
G'day, Brian. How are you now?
Now, good, thank you.
Yeah.
Now, for a start then, we always talk about trading tips for the day on this show. James, your thoughts on on what you'd like to share with us?
Well, there's a few things that are going on. I've got a few rules for trading and some tips for trading. I think that now more than ever, we've got a few big things on the horizon, which is a pretty throwaway thing to say. You can always say that any time with the markets, but as opposed to usually just taking the coin and flipping it on these ones, you can usually have a pretty estimated guess about where the market's going to go. We know that the Fed have potentially, that is the last of their raises, that they're either going to hold, so that they're in the pause, and then eventually the next step is going to be cut. All of these things we know. We know that G7 is coming up next week. So that's something that potentially was a risk about what the decoupling is going to look like potentially between the US and China. We've also got this this debt ceiling that the US are hitting, and a lot of people saying that that's going to add this huge risk factor into markets. The trading tip for you, Brian, and the trading tip for anyone who wants to listen as well, is that once something gets talked about enough, it stops being a thing, and it just becomes something that is factored and absorbed by the market. Anyone who says that, oh, this thing that I'm seeing in the paper, I've read on Bloomberg or seen on CNBC or anywhere like that, that people are saying is going to be a huge risk, a risk to markets. Once you've seen it, once it's there, chances are a lot of it has already been discounted, and then you need something even bigger and more shocking to actually move markets. For example, the recession that we've got ahead of us now, it's factored in, it's baked in. So now the only way that it's going to cause even more of a shock to markets is if the recession is much, much worse than where people are sort of placing it. So the recession itself is not the fact. It's been talked about enough. It's a thing. Move on to the next thing. So let the market discount things as it should.
Vee, your thoughts on this, Vee?
Yeah, I think James is absolutely right, and that's why the markets are difficult, right? If you could read Financial Times, I mean, no offense to Financial Times, it's a great source of news, but if you could read Financial
I've got it open here.
Read the markets, everybody will be winning, right? It's kind of it's much like the sports analogy, right? You want to skate to, from ice hockey, you want to skate to where the puck is going to, not where it is right now. So it's, as James said, if it's talked about a lot, it's everybody is pricing it, right? So you actually have to understand how much is being priced into the markets, how much, in the case of the recession, how much of a recession is the market expecting. And this is one of the most anticipated recession in recent history, right? So it has to be a lot worse than what is being anticipated. And that's where experts like James come in. They're going to tell us what's already been priced and what we should be looking out for.
Yeah. Okay, now Vee, I want to zoom in on you again and to look back of some of our predictions from our previous shows. What are you seeing that's interesting, and perhaps we can get James's insights, especially that look around commodities?
Right, cool. So we were having a discussion with James earlier, and one of his trading wisdoms that he lives by is just follow the money flows, right? And it's interesting that he brought it up because recently it came out in the news. China has been buying gold for the 6 months in a row. The MAS, the Monetary Authority of Singapore, is adding to its reserves as well. And Singapore's government, the reserve management, is buying gold as well. Turkey is also buying gold. I think a lot of all these nations with excess savings, they're starting to move their reserves into an alternative of to the dollar. So we've been saying that we like gold and silver for some time now, and it's been performing okay. It's been doing well. It's going in the right direction, and I believe that it's going to break to new all-time high soon as soon as the Fed stops hiking interest rates and inflation starts to come off aggressively in the later part of this year. So what's your thoughts on this, James?
No, I think that you are correct for the most part. I think that obviously the move has happened in gold that we've seen. Now, I'm not saying people have to understand that when I say I don't see the buy opportunity there that was there before, just merely the risk reward has changed. Gold was absolutely one of the easiest things to see that it was going to happen. However, the number of times that I've said that gold is an easy buy and been wrong, if I got $1 every time I do that, then I wouldn't have to be sitting here talking to you people, with all due respect. So, there has been some substantial buying from the central banks that's going on. There's been 228 tons of gold has been bought in the first quarter of this year just by central banks alone. And that has been amazing. I'm looking at the amount of gold that's being picked up and bought. This is what happens when inflation starts to tweak down, and we see the potentially. Here's the thing, though. We're at the end of the Fed hike cycle. The Fed controls everything. Do not ever forget that. Whatever happens is because of what Jay Powell says on those Thursday mornings, and we're all wake up bleary-eyed in Sydney time. We start the day based on that. Here's some stats on gold. Gold returns a negative 7 out of 10 times after the last hike from the Fed. So this is historically speaking, and it averages a negative 13% return in the 3 months following the last Fed hike. So you can love gold long term, but if the dollar has a risk-off moment, and that's what, don't forget, the Fed controls the dollar. Well, the Fed decisions control where the dollar goes, and where the dollar goes controls where gold goes. Effectively, if you just want to have an all things play, created equal sort of situation over the next 3 months, dollar comes off, you're going to see gold sort of start to struggle through that particular way. 13% average return in the next 3 months. That means, now here's the thing, V, this is where we can agree but disagree at the same time. I don't think that gold is the right risk return right here and now. So let it come off, let it play. Try and find technical analysis does come into it sometimes in my life of looking at when really big thick lines can be drawn as a support line. Find a really nice big line and be a buyer there in another 3 months' time if you think the Fed is done, which I do believe that they are, and the market does also believe that they are done too. Inflation comes off, gold, the US dollar comes off, yields come off, bonds rally, gold comes off, gold becomes a buy. Eventually, equities will become a buy as well at a certain spot once that earnings downgrade has come in. Now you just know my whole playbook for the next few months.
Right. So your playbook right now is to buy bonds. Is that right? That's the first
long bonds.
Long bonds.
Absolutely. I want to be easing out of equities, and I want to be having a look at the bond space. I think that just naturally bonds do just go up during this time, and that's pretty easy. This is as easy as that gold trade was. You know that they're going to be holding rates steady. But then you also know that every time that we're going to look at what they've done, we're going to start to see some recessionary impacts coming through into the US. So that's going to be bullish for bonds and maybe negative for equities, because you've got to remember that there's some big chunks of the equity market that are being held up by just a few big tech stocks. Big tech has been, I think, attributed for around 90% of the run in the in NASDAQ, I believe, actually. So, but also in the S&P 500. If the S&P 500 index weighted has been rallying, but actually equal weighted, it's all pretty much flat. It's not an amazing thing on some days that you can see. Some of those big stocks have been running quite well. Now, I'm not saying get rid of those big stocks. I'm just saying that those big stocks, if they stop running and if they stop moving, then the actual index itself is going to start to struggle and probably be seen as a bit of a sell, especially if you've taken your money. And especially if you can see that there's value in the bond space. That's that relative value conversation that we can have at a later date. But that's that trade where you can go to an easy thing, bonds to rally, yields to come down on disinflationary. You've got to make sure you get that right, not deflationary, disinflationary pressures to the downside, and then Fed conversation saying that we might be on target to get below our inflation rate. And there you go. And you've got your trade. Really sort of simple stuff. And just sort of how much you weight that 60-40 portfolio is all going to be determined in the next few days or weeks to get you through to the next quarter.
V, your final thoughts before we wrap up for today?
Oh, final thoughts? Okay, then I have no time to ask him questions. But
Go
ahead.
I think I agree with James in that I think we've seen the peak in interest rates, peak in bond yields. I think the Fed is fighting an enemy that is in the rearview mirror. They're thinking about inflation when I believe this inflation is as James said, this inflation is very much on the radar right now. I think we're going to see extreme tightening of credit conditions because of the bank failures. We saw yesterday from from the Federal Reserve loan survey that credit conditions has tightened further since the failure of Silicon Valley Bank. And I believe that's just a start, right? It's just one of the first few banks to fail. We're going to see more worries in the banking sector, and it takes time for loans to be rejected. I think we're going to see more of this happening, and we are going to see also what we saw when inflation was spiraling up. It was very aggressively spiraling up, and when it starts to go down, I think it's going to be reinforced this way as well. There's lagged effects in monetary policy. It depends on your estimate. It's between 1 to 2 years of lags. We are now seeing the effects of the last year's basically a cumulative hike of 5%. We're starting to see it filter through the economy in the next few months and later part of this year. And there's a reason why markets is pricing for a lot of rate cuts. It's one of the most rate cuts at the end of not quite the end of a hiking cycle, and it's very rare for Fed not to deliver on price rate cuts. So I believe I'm on the same page as James on that. I'm a bit mixed on the equities. I believe there are still sectors that will continue to outperform. As he said, it's the tech. I think the revolution in artificial intelligence continues unabated. We're going to see that as a driving theme for the tech sector going forward as well.
Yeah, I see that too. I've actually started picking up data centers specifically. I don't want to talk about a specific stock, but data centers in general are going to be a great buy long term as more and more capacity is being taken up for artificial intelligence, the amount that's moving into that and the amount of space that's needed for artificial intelligence. So there's some amazing value in some of those data center plays if you can pick them out individually. But I implore you to go and have a look at that yourself. There's some really good names that are in that space.
And it's interesting that you say that, because basically in our part of the world, in the Asia Pacific, there is an explosion of data center construction. So many of those stocks which you are not naming are basically constructing data centers in places like Malaysia, Australia, Vietnam, and the Philippines. Because they can't construct data centers in Singapore anymore.
No, there was something about that, wasn't there?
Yeah, yes. Absolutely. Now, gentlemen, it's been a pleasure having you all on the show. We've run out of time. Thank you very much for taking your time to be on the show.
No problem at all. Good on you, Brian.
Data center thing, I'm going to have a look at it right now.
Yeah, I'll give you the name of it after the show, mate. It's all good. But it's great to talk to you too, V. Thanks a lot, Brian.
Yes. Now, that's it for this week's Inside Trading Show. We've been speaking to Phan Vee Leung. He's the founder and CIO of Track Record Asia out of Singapore, and James Whelan, Managing Director of AMFEX, the Australian Mutual Funds Exchange, who's coming to us out of Australia on BizTech's Inside Trading Show. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.